Hey, it's Ryan from the Option Income Advisor, and today I'm going to talk to you about Alibaba. We've had a couple videos in the past on this stock, but I got a lot of questions about it yesterday because they reported earnings and they gave investors a triple whammy of missing both top and bottom line, as well as reducing their forward guidance. But I want to put it in perspective because it's not a miss, I think, that you should be overly concerned about based on where the price is. So the stock did trade off an additional 11%, but we're back down in the 140 range, which is this long-term kind of support level that it's kind of come down to. And that's actually a good segue right into the chart. I don't need a big introduction here because I'm going to walk you through the chart, the valuation, and I really think that even with their lowered guidance, this thing makes a ton of sense right now. So I'll kind of walk you through it and tell you my thoughts, and you can come to your own conclusions. But I think this stock has some room to move, and I'll kind of walk you through that. So let's take a look at the chart. So you can see here I put these little bubbles out here, and I went all the way back to 2018. Okay. So this was basically October of 2018. So that was 3 years ago. Okay, that's when the stock originally kind of went down and hit this 130 to 140 level. So that's basically where we are now, right? We closed yesterday at 143.60, and so obviously the stock from 2018, had some choppiness in there, but basically doubled in price. Hit a high of about 315, 320. And then as regulatory concerns kind of creeped in, it's just kind of been a free fall since, right? And so, this has really been, the big issue has been the Chinese regulatory concerns. And I think it's starting to show up a little bit in earnings. But let's peel back the onion a little bit there and see if it's really something to be overly concerned about or if it's just slowing growth. But I put these in here because I want to just put it in perspective because I thought this was really interesting. So back in 2018, their trailing revenue and EPS was $38 billion on an annual basis, and their annual EPS was $3.71 per share. So fast forward now, 3 years later, we're basically at the same stock price, but they've almost tripled revenues and over doubled their earnings. And actually, this is trailing earnings based on 2021. It's March of 2021 annual sales and EPS. They're actually projected to do, even on a lowered guidance level, something around like the 140 billion of revenues. So if you think about that, they have actually more than tripled revenues since that time. And so, I mean, that's perspective for you right there. So they've tripled their revenue and over doubled their earnings on a trailing basis, and we're at the same stock price we were 3 years ago. So peeling that onion back a little bit, let's talk about kind of what happened with the call yesterday and kind of what they reported. So they lowered their forecast. And folks, this you're not going to see numbers like this. Even just looking at what we had, recently with NVIDIA, right? NVIDIA's been blowing away earnings. They're trading at a very healthy, probably stretch multiple of almost 70 times earnings. We've got a situation here with Alibaba, by the way, where it's trading at 13 times forward earnings, which is insane for a stock growing or a company growing this fast. Okay, so they reduced guidance, so they missed their top and bottom line because of the few things they mentioned were obviously just a kind of a slowing economy there. But I think we all know that they took COVID, very, very serious there, kind of shut everything down. Just, I think, probably starting to get back up and running. It really stopped, e-commerce quite a bit as well. And so that was some of the things they pointed to. So they had that kind of slowing economy, due to COVID, and then they're having supply chain issues just like we are. So it's not crazy to hear that maybe their earnings slowed a little bit, over the past year. But the other issue that they kind of raised, which, this is the one that's a little bit more uncertainty, is from a regulatory standpoint, they're wanting more competition. And so they're introducing other competitors, which is supposedly taking market share away from Alibaba. Again, this is the Amazon of China. They're in all kinds of things, kind of like Amazon is. They've got a cloud business, entertainment business, on top of their their e-commerce business. So, they've got their hands in a lot of different things. And so you think about that. Okay, they missed. I think they're reasonable things to point to as to why they missed. But then you look at the guidance and you say, well, what's the guidance here? So it was, they lowered their forecast from 29% revenue growth to 20 to 23%. So they're still projecting to grow, even on a reduced basis, by over 20% a year for the next few years on both the top and bottom line. You are not going to find a stock out there that is trading at 13 times forward earnings that's growing at 20%. And so again, to put it back in perspective with NVIDIA is growing about that, maybe even a little less. I mean, I know NVIDIA's forward guidance is only in the 12 to 15% range for growth, and it's trading at 75 times, right? This is trading at 13 times with, sales and earnings growth estimates in the 20% range. So that's just an insane kind of situation there where something doesn't seem right there. And I think it's just the market has oversold and overcorrected what is really happening there. I think there is continued, heightened regulatory concerns. But if this is all it's turning into, where it's reduced it from 29% down to 20 or 23%, and if we can hang our hat on that for the next couple years, I mean, there's no reason why this stock should not be at, $180 to $200 a share on a conservative basis, right? I mean, there's no reason why this stock, should not be, you just do the quick estimates. So by the way, we've got, so this number was reduced to like 850. That's the number that they kind of reduced it to. And then we've got, it used to be for 2023, and that's what these, I'm laying this out here because that's what these forward estimates are based on. So the 2023 numbers, we're looking at 1044 roughly. And that's down from about 1090. So they reduced that, by about 50 cents. But if we come anywhere near that 1044, I mean, you could even round it down to 10. If they can just do $10 per share in earnings in 2023, I mean, that's real simple math. And we can expand the multiple here to say 18 to 20 times. That would not be a crazy expansion of a multiple on a stock like this, especially growing, basically just getting it up to what its growth rate is, right? So if you're thinking about it from a PEG ratio, right? The PEG ratio is the, PE, price to earnings ratio divided by the growth. And so they always say if you have a PE or a PEG ratio of 1, it's a phenomenal risk reward, right? You're actually growing earnings at the rate that your multiple is sitting at, right? And most companies don't even get anywhere near that. I mean, you think about NVIDIA that's trading at 75 times, but growing at only 15 times, right? So that's actually, it's growth divided by the PE ratio. So, that is just an awful PEG ratio. And so if we put 18 times our $10 a share, we're talking about on the low end, it should be up in the 180 range, and in the high end, again, this is simple math here, we're at 200. So there's no reason to think that if we can really get behind these numbers, and if this is all that's going to happen from this kind of increased competition, regulatory concerns, because I do feel like the Chinese consumer is probably going to be coming back much, much stronger in the quarters ahead. But again, even if it's 20 to 23%, I feel really good about paying 13 times for that stock right now, right? Because I think the upside here seems pretty simple, and that equates to about a 25 to 40% upside from the current prices, right? And so, again, I think there's going to be some unknowns, and I think that's why this stock, again, probably isn't trading at 30 times, which it probably would if there wasn't this uncertainty out there. So again, even giving yourself just a little bit of margin expansion here, or multiple expansion, knowing that there still might be some overhang there, I still think you can justify certainly buying it at this price, and definitely, I think, hanging your hat on some real significant upside in the future here. So that's my take on it. I think it's pretty simple. I didn't see anything. I listened or read about the earnings and didn't get too spooked out. I was shocked that the stock actually traded down 11% based on where the multiple already is. I just don't think you're going to find this kind of multiple for a stock growing at this level. So again, take it for what it's worth. I think the regulatory stuff is still out there, but I really like the risk reward here. And then again, going back to the chart, this is a stock that should have some significant support here at the 140 range. That was the range it hit back in 2018, and then it hit it just earlier, about a month ago, 2 months ago, bounced off that level, ran all the way almost back up to 180, and then has come back down. So I don't see why that this stock can't bounce right back off this level up into the 180 200 range in the short term. And again, I didn't see anything that overly spooked me out about about their guidance or why they were missing the top and bottom line. I think it's all kind of reasonable stuff based on what's going on. So that's my take. I'd feel comfortable buying it at this level. If you are a little more conservative, maybe want to just do the cash secured puts, love the cash secured puts obviously as well. I think you can get extremely juicy risk reward here in the if you just look again, I think that 140 is probably going to I would assume that probably holds this time as well. But even if you look down at I'd say anywhere between the 120 and the 130s. So, you've got even down at the 120s, you can get 1.2%. That's only a 12 delta option. You got another 16% of margin of safety there. That's almost a no-brainer. But again, kind of adjust, your risk levels here. A lot of you probably already own the stock. I would feel comfortable adding here at the 140 level. But, if you wanted to be a little more conservative and earn some cash and just wait for a little bit better price if you think we're going to get there, there's nothing wrong with that. And you can get paid really well. Even at the 130s, you're getting 2.4% on a monthly basis, and it's still, a delta under 25. So I love that risk reward, if that's something you want to do. But I would do a combination. If you already own some stock, maybe you add a little bit more here. And possibly sell a put or two, at a lower price here. So I love it. I think it's one that you should definitely have a full position in. That's our analysis. Take care.